I worked at a series of car dealerships while I was in college, and it was very eye opening from a personal finance perspective. This was pretty soon after Cash for Clunkers, which was an Obama era program. They were trying to kickstart the economy after the crash, get people buying stuff, giving people rebates to buy newer, more gas efficient cars. I wouldn't exactly call it successful. So, what happens if the car market crashes again? Firstly, a bunch of people are going to be upside down on their loans, meaning they will owe more than the vehicle is worth. Dealerships are going to get squeezed, and banks might panic slightly. Used car prices are going to go feral. This would take three ingredients. Number one, people buying cars they can't afford. Too many people are buying $70,000 plus giant SUVs and trucks for their 12-minute commutes. For some reason, people are taking out 84 to 96 month long loans on a depreciating asset. And then they wonder why they're broke when their car payment is the same amount as my mortgage. Just because you can make the payment or you were approved for a certain amount doesn't actually mean you can afford it. And it definitely doesn't mean it's a great idea. A lot of people don't realize that, so there's a lot of fragile loans out there. Number two, if interest rates stay high, there's going to be more delinquencies, which means more repos, which means more banks dumping repoed vehicles, which would mean even more people owing more than their car is worth. We call this a negative equity bomb. When I worked on the car lot, the salesman made a game of how much negative equity they could wrap into a loan. So if you still owed $3,000 on a car that you were trying to trade in, they would try to add that $3,000 on the car you were trying to buy. And they would continue doing this every time people would come in and upgrade. A lot of people upgrade their cars every 2 to 3 years. There are people out there that owe twice as much as the shitbox they're driving is worth. If you get into an accident and you're in this situation, you're basically fucked. Number three, used cars correct to match. If new cars are super overpriced, they're going to move the price of the used cars to match. Car dealerships get rebates from new cars from the manufacturers. They don't get that from used cars. And they've got to make up the extra money somewhere. If that happens and then prices return to reality, there's going to be even more people also upside down on used cars. So for consumers, this means a massive wave of negative equity, more repossessions, and more people trapped in loans that they cannot refinance. No bank is going to help you refinance $10,000 on a 2008 Kia Rio. Dealerships are going to be stuck with overpriced inventory and their profit margins are probably going to collapse. Smaller ones may go out of business. Lenders will probably see a rise in defaults, and banks could make loans harder to get, which means less buyers and therefore an even deeper crash. Manufacturers could cut production if no one is buying or delay new models, and they will probably try to distance themselves from the $90,000 mega cars that they're known for. Automakers get way more money sticking you into a giant SUV or truck, and the salesmen get really high commissions. What do you get out of it? A car that's pushing you further into debt with every payment, every huge tank refill, every overpriced insurance premium? And for why? So you can look cooler to your peer group because you think that the cars causing the most accidents are somehow safer?